data tomorrow morning. So, Josh Brown, what do we think here? Regional banks lower. PacWest is down a bunch. You had that loan officer survey show credit tightening, loan demand is weakening. Austin Goolsbee, vibes of a credit crunch beginning. I think we're trying to make sense of it all, but the inflation stuff is really front and center for us.
Yeah, well, this is what the Fed wants to happen. They want the availability of loans to decline. They want there to be less borrower demand. So this is like literally the whole point of doing 500 basis points worth of rate hikes. You want to produce those because you think there will be a knock-on effect where prices cool off. And to some extent, you're getting your way, but you're not getting it in the labor market. And it's really, I think that is the big standout. That's the thing that everyone's waiting for to turn. Has not turned yet. You had a little bit of a deceleration, but nothing to write home about. And it's frustrating because you look at an unemployment rate after 500 basis points in rate hikes, that's gone from 3.6 to 3.4. It's pretty rare to have a tightening cycle this severe and this prolonged where you literally just get no budge out of the headline. You're not even really getting it in terms of wage growth the way that you'd expect to see it at this magnitude. The beat for April was just the icing on the cake. But then you look at things like gas at retail stations. $3.49 is the national average. That's down 86 cents per gallon from 1 year ago. Clearly, there's some impact there from rates. So, you know, if you're of the mind that this is going to get worse or it's not getting better, you'll point to labor market. And if you're of the mind that, hey, we've seen the worst of this, the Fed is getting its way, we're pretty much done with the tightening cycle, you'll point to things like gasoline, durable goods demand. And that's not going to change until all of the data is moving in the same direction. And we may need to wait on that.
What about, Jenny, the debt ceiling issue, which, you know, is obviously percolating. It's not sort of boiling over yet. It's not showing up necessarily in the market unless you look at the extreme short end of the bond market, where you've got 1, 3, and 6 months are all over 5%. Sort of obvious what's taking place there. At what point does the market start to pay more attention? If the headlines are bad today, 4 o'clock is this meeting, right? President, the Speaker, other congressional leaders as well at the White House.
I think the market doesn't start paying attention until we actually stop paying a bill, like what happened in 2011. Because what we've all become inured to is political theater. And I think we're kind of all expecting this to be the same. I think we know that this ridiculous government is so divided. They bring everything to the last inning. They bring it to the to the end. Right. They can't just do their job and get the job done in a functional, useful way that would make all of us, happy. It's ridiculous. Like, this isn't that hard a thing to solve for. And I think that's what everyone's expecting, that like they're going to get there. They're just going to torture us in the meantime. And so you don't want to put your money at risk betting on either side of that. One quick aside, I think one of the biggest investment mistakes I ever made was not buying Lockheed Martin back in 2011, when they actually had problems with negotiating the debt ceiling. And so I look at this as, if we get there, we know they'll still figure it a way out, and that'll be a big buying opportunity.
Joe, what do you think is at play here between the loan officer survey, the still unsettled feeling in the banks, debt ceiling, and then, of course, the inflation reads over the next couple of days, CPI tomorrow, PPI the following morning?
I still use the word resilient. It's remarkable to me how the market is performing with all of the headwinds we have in front of us. If you look at the KBW Bank Index, which is 24 banks, it's got $1.2 trillion in market cap. That index is 25% below its 200-day moving average. Think about that. And that's not dragging the S&P 500 down. In the last 20 years, every other time that index was down as significantly as it is currently, the S&P has gone down along with it. So there's clear resiliency. I absolutely think the price that you pay for combating inflation has to be an economic contraction. I think we are in the middle of seeing that. It's only going to intensify in the coming quarters. You have a lot of consumers who are still relying on the debt and money factors of 2 and 3 years ago, and really are not aware of the waterfall that they are about to experience when they go back and they try and extend those maturity, whether it's on a car lease or a car loan. So that's all coming ahead. And I don't think we could expect, to Josh's point on the distortions in the labor market, I don't think post-pandemic we could expect any of this to be normal, because nothing's really been normal since March of 2020.